Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cash Flow King with you today. And in today's episode, is my retirement plan free? Spoiler alert, no, it's probably not. Thanks for checking out the show. As always, we really appreciate it. In today's episode, we are going to talk about some things you might want to be thinking about or looking at when it comes to your retirement plan, specifically your retirement plan at work. So I can't tell you the number of times I've met with a client or prospective client and they have investments elsewhere and they proceed to tell me that they're not paying anything. Or if they have a retirement plan at their workplace, that their retirement plan doesn't charge any fees or that it's free. And while technically, in theory, that's possible, in practice, in the real world, it is highly improbable. In other words, no fucking way. So I want to talk a little bit about some things that you might want to be thinking about and looking at when it comes to your retirement plan at work, with a specific focus today on the fees. Because there's a lot of people, rightly so, that are very fee conscious and they're always focused on their fees and expenses and what they're paying. And I do think that's extremely important. It's something that I also focus on. The other thing, though, that you want to make sure you're keeping in mind is for what? You're paying X for what? So let's start with most plans out there, and yours is probably going to be a variation of this. And I should start by saying we are going to specifically focus on what's called DC or defined contribution plans, not DB or defined benefit plans. And that's just a fancy way of saying a defined benefit plan are sort of the old school pensions, traditional pension plans, where you went to work for an organization, you worked there for several decades based on your length of service, your income, some formulas. They provided a benefit for you, a defined, stated benefit for you in your retirement. You got a pension check to your face every month in retirement forever. Those, unfortunately, have gone by the wayside for a lot of people. They still do exist, but they are less and less common. And instead, and that's not what we're going to talk about today, instead, what more and more people have are these DC or defined contribution plans, which basically says, hey, we're going to define how much gets contributed to these plans, and then fuck you, you're on your own, right? Good luck, figure it out. That's a lot of the 401k plans and those similar plan types of the world, right? So if your employer has a match, how much do they put in? How much do you as the employee need to put in if you want to be eligible to capture that match, right? We're defining the contributions, the amount of money that's flowing into these things. And usually that's a percentage. Sometimes it's based on a dollar amount. And of course, there's going to be IRS caps and all that shit. But the point is, today's show is on those defined contribution plans where you're probably putting money in, your employer is probably putting money in. There's probably some formula that, dictates what the match is. There's a vesting schedule, stuff we've talked about on the show already. Those are the types of plans that we're going to talk about. But today we're going to take a magnifying glass in a way, and we're going to put it over the fee component of this. And the first thing I'll say is that plans can be, and I've seen this firsthand, drastically, and I mean drastically different when it comes to fees and expenses, okay? They can also be drastically different when it comes to what you're getting out of the plan in any sort of service expectations or service level agreements that are out there for these different types of plans and the services that they may or may not offer. So, a generalization and a good place to start would be, generally speaking, the larger the organization that you work for, the more competitive the retirement plan is and the lower the fees are. The smaller of an organization that you work for, in general, the fees are higher and the plans may not be quite as competitive. Now, I know someone's going to be listening to this and say, I work for some startup company and our plan is great and our fees are low and blah, 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 blah. Good for you. That's awesome. But that's not the case for most people, okay? So that's a general place to start, all right? Now, in order to lead into some of these fees, I first want to talk a little bit about the different ways that most people can invest inside of most retirement plans. Okay. So most plans out there now, and more with Secure Act and Secure Act 2.0 and all that stuff, they are getting involved with automatic enrollment or auto enroll, meaning if you go to work for an organization, they're automatically going to enroll you into the plan. They're going to start contributing a set percentage of your pay. They are going to put you in a default investment option. And it's up to you whether or not you want to change that percentage in terms of what you're contributing, whether or not you want to change the investment that they put you into if you think it's a good fit for you or not. And there's a lot of considerations around all that stuff. But that's more and more what we are starting to see in the retirement plan landscape today. Now, most plans, you can invest 2 to 3 different ways. And when I say 2 to 3 different ways, I don't mean 2 to 3 different investments, but rather 2 to 3 different categories. Okay? So the first one is the do-it-yourself method. This is plans that have a menu of investment options. Typically, they're going to be mutual funds where you can pick and choose your own funds, your own allocations. You can log into your account, rebalance yourself. You can do all that on your own if you choose to. And this is actually what I do personally. Our retirement plan at work is very low cost. It is extremely competitive. It's also very low service, meaning that I don't have anybody that helps me out with anything, with one exception, which I'll get to here in a little bit. But I don't really need that because this is what I do for a living, so I don't give a shit, okay? And I can set it up in that account where I can pick and choose my own investments, and I can also set it to automatically rebalance for me at a certain frequency into those targeted allocations. So your plan likely has a similar option where if you wanted to go in and look at the fund fact sheets and the prospectuses and all those sorts of things, most stuff that people never read, but you should, and you want to pick and choose your own portfolio and your own funds, and I want this percentage here and that percentage there, you could do that. And for a lot of plans, most plans, this is typically going to be the lowest cost option. Why? Because you're doing it yourself. Does that mean it is always going to be the lowest cost option? No, and I'll explain why here shortly. But if you're somebody that has or wants a fairly basic portfolio, you have an inclination and a desire to do what I just mentioned about reviewing the fund fact sheets and building the portfolio, and that's something that interests you, then there's nothing wrong with going this route. And there are a lot of people that do this. Not a ton, but there are a fair amount of people out there that are, in the financial independent space and the podcast world that are involved in some way, shape, or form with personal finance that want to be a little bit more hands-on. Nothing wrong with that. Okay? And that's fine. That's one way to invest, and generally that's going to be the lowest cost. There's nobody that's doing it for you per se. You're picking your own funds. You're setting your own auto rebalance or manually logging into rebalance if you want to do it that way. There's less that has to happen. So generally speaking, your expenses are going to be lower, and we'll come back to this. I know I keep saying we'll get back to this, we'll get back to that. There's a lot of moving parts, and we'll hope to bring this full circle here shortly. That's the first way. Do it yourself. Okay. Number 2 is the plan's default investment option. Going back to the auto enrollment comment, this is where they put your money for you if you don't do anything. And different plans were set up differently. Some of them still are a little bit different, but most of the plans today will have a default investment option that is some sort of target date fund. For example, it might say target date 2050, and maybe it's a Vanguard fund, or maybe it's a Fidelity fund, or maybe it's a T. Rowe Price, or whomever, whatever the investment company is. And how they determine what you as an individual employee get put into versus your coworker who might be 20 years older or younger than you, what they get put into is strictly based on your date of birth, which in turn produces your age, and what the plan will typically call the normal or default retirement age of the plan. They have to draw a line in the sand somewhere and make the assumption that, hey, on average, most people are going to retire at age X. A lot of plans out there will use 65. Some of them will use 70. Could be a little bit more or older. Could be a little bit younger or less. But they're going to have to draw a line somewhere and say, all right, based on your date of birth and the plan's normal retirement age, we are going to automatically, by default, place you into this target date fund, okay? In the year, so in my example, I think I said 2050. In the year of that target date fund, in this case 2050, is supposed to coincide approximately with the year in which you might retire based upon the plan's default or normal retirement age. So again, you personally might want to retire at 60, but the plan's normal or default retirement age might be age 65. They might assume you're going to work an extra 5 years. So they will place you in a fund accordingly. So with 2050, it assumes you're going to retire in or around the year 2050. So the further out you are from that, then generally the more aggressive these target date funds are, meaning that there can be larger short-term fluctuations. A larger percentage of that investment or that fund is typically invested in equities, or that's a fancy way of saying stocks. And as you get closer and closer to that year, in this example 2050, you'll be on what's typically called a glide path, where the fund will automatically adjust and automatically tweak those investments to become gradually more and more conservative as you get closer and closer to retirement. So as you get closer and closer to, in this example, that 2050, the fund will have less and less stock or equity exposure. Typically, it will have more and more bond or fixed income exposure until it hits a certain target. And then that will continue to adjust throughout retirement. So even after you're 10 or 20 years into retirement, there are still adjustments that are happening inside of that fund. And you might be sitting there thinking, well, this is fantastic. Who the hell wouldn't do this? Well, it is okay, and it's directionally correct for most people. And that's part of the reason why a lot of these plans have it as the default investment option. That's great. However, it may not be right for everybody. Again, what if you're somebody where they're assuming you're going to retire at 65 and you want to retire at 50? Well, there's a 15-year difference. What if you have two people that are exactly the same age and one of them loves their career and wants to work until 70 or 75 and that other person wants to retire at 50? Well, again, we have another discrepancy. And then the person that wants to retire at 50, maybe they already have a significant amount of money invested from prior employer plans or Roth IRAs or brokerage accounts, or maybe they walked outside and $10 million fell out of the sky and hit them in the head, right? You just don't know. There is no accounting for individualized situations or situationally specific financial circumstances, right? Where two people are. What have you done up until now, and what is your plan going forward? They are simply saying, hey, based on your age, this is where you should be. So one of the analogies I like is it's kind of like you go to the doctor and they walk in and say, hey, how old are you? And you give them a number. And then they start writing you a prescription. And you think, wait a minute, you don't even know why I'm here. Well, that's kind of these target date funds, right? They might say, well, you told me you were age X, and most people your age have these types of problems, so I'm going to go ahead and write a script of all this shit that you should probably take, that you may or may not need, but you should probably take it anyway because most people your age need this stuff, right? That's kind of like a target date fund. Again, it's not bad. It's not terrible. It is generally directionally correct, but it's not very precise. Now, with regard to the fees, these can be all over the place. I've seen some plans where these target date funds can be 5 to 10 times more expensive than the individual funds where you can pick and choose and do it yourself and custom build your own portfolio. I've also seen some plans, and ours is one of them, where the costs are fairly comparable. In other words, whether you custom build your own portfolio in our plan or you go with a target date fund in our plan, the fees and expenses are actually pretty much on point and parallel with each other. That's not the case in all plans. In fact, most plans that you see out there, the target date funds are a little bit more, sometimes significantly more expensive. Keep in mind, what are you getting for that, right? What's the value proposition? Well, if you do it yourself, unless you're moving money around or setting it up to auto rebalance and things like that, you're pretty much on your own. With the target date fund, everything is happening for you in the background. You really don't even need to think about it. And that's one of the largest appeals of this, is because people can kind of set it, forget it, and not have to do a ton with it. And that's fine. Just understand that that's what's going on. The other thing is, not all target date funds are created equal. So again, I mentioned a few companies, and I'm going to pick on them again. Vanguard, Fidelity, T. Rowe Price, the list goes on and on. They might all be managers or sub-advisors of different target date funds, but they might all manage to a slightly different investment philosophy. So in other words, if you have two funds that are 20/50 funds, generally speaking, they're going to be pretty similar. However, there might be one company that has a more aggressive allocation and another company that manages those same 2050 target date funds that has a more conservative allocation. Now, normally in your plan at work, they're going to have one fund company that does all of them. So they're all going to be, Vanguard or Fidelity or T. Rowe Price or BlackRock or whomever, right? That's going to happen. But some of those companies, if you worked at company A that has BlackRock and they have a 2050 fund, and then you went to work somewhere else at company B and they have, Vanguard that has a 2050 fund, perhaps their allocations are a little bit different. And one of the biggest things that we've seen in the industry over time is that, generally speaking, and this is my opinion, but I have the data to back this up, some target date funds are not aggressive enough for younger folks, typically. And some of them may be too aggressive for older folks. And again, a lot of this is going to depend on the rest of your financial situation, which these target date funds, unfortunately, don't consider. They're only looking at your age because, again, they have to draw a line in the sand and start somewhere. So these are, again, okay. They're directionally correct. The expenses may or may not be more than the do-it-yourself method, something to consider. But if the expenses are on par with each other, and you feel like your situation is fairly straightforward for somebody your age, you're not looking to retire significantly older or younger than most, you feel like you've invested, sort of average, if you will, over time in terms of the amount of money that you put away for yourself, maybe these work just fine. There's nothing wrong with them. I'm not trying to bash them, but I am trying to just highlight some differences. So that's an option. Some plans may only have those two, the do-it-yourself or the target date. But then there's a third option that more and more plans are coming out with. And every plan calls it something a little bit different. And these are, some people will call them managed accounts or advisory accounts. These are target date funds, but more custom in a way. So they're going to ask you more questions about you as an individual. When do you specifically want to retire? How much are you specifically earning? What are you contributing on a percentage basis? What other investments might you have? It's like the doctor walking in and asking you about your symptoms before they write the script. That's the analogy I typically like to use. So that's something to keep in mind. Now, sometimes all in, the fees and expenses can be pretty comparable for something like this to a target date fund. And other times, they're not, because most plans will charge an additional fee for this service. And sometimes this fee comes with access to a financial advisor. That could be a person that you actually physically meet with in person. That could be a person that works in a call center. That could be, a person that works virtually. Whatever the case might be, you typically will have access to an advisor. Sometimes it's a team of people. Sometimes it's a dedicated advisor. Sometimes they might be credentialed. Sometimes they might not be, depending on, again, what the program is that you're paying for, what the cost structure is, and the type of clientele that they normally work with, right? So there's all different varieties out there. But for those that want something that's kind of autopilot, set it and forget it, and want something a little bit more customized, maybe they do want to retire early, or maybe they're getting a late start, or maybe they have a significant amount of money and they started investing really, really early, and they know that the advice for them is likely to be different than for the next person their age. These are all reasons you might want to consider some sort of advisory services or managed account type of option, okay? This is typically, just like the rest of the fees and expenses, deducted automatically from your account, right? We want to make it in the financial services industry as easy as possible for people to give us their money. There's a running joke out there that basically talks about, we want people to put in as much money as possible, leave it there as long as possible, take out as little as possible, and we're just going to suck the fees out and cash flow ourselves to death, out of their portfolio. And that's essentially what the financial services industry is. And I hate to say that, because there's a lot of us that work in the industry that are really good at what we do, and we help people, and that's what it's all about. However, there's also a lot of money to be made through these types of plans. If you're not writing somebody a check, right? If you're not having a bill automatically hit your credit card that you see on your statement, if it's just coming out of your retirement plan and you have say a quarterly statement, for example, and it's just buried in there as one line item, most people aren't necessarily going to see that. Some might not, but they make it easy for you to pay for these services. Is it worth it? Again, it depends. For some people, yes. For other people, no. And there's some people on both sides of the coin that have strong arguments for or against it. So you got to do what works for you. If you're never going to make any changes and you don't want the same portfolio when you're 65 that you had when you were 25, and you're not in a target date fund, or you don't like the target date funds and yada, 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 well, then maybe it's something you consider. And a lot of plans out there will have different sort of introductory, I don't want to call them teaser offers, but some plans, when they first introduce a service like this, they'll say you get your first X number of months for free, or your first, for X period of time is at a discounted rate, or if you have under a certain amount of money in the plan, it is free until you hit a certain threshold. There's different ways that they structure these, and again, they make it very, very easy for you to stay in these plans. There's a lot of us that make a really good living off of people that utilize these plans. Some of the plans provide great services and have access to wonderful advisors that can help people with other things in addition to their retirement, or looking at more than just their 401k plan, for example. Other ones might not. So you really have to, I don't want to say be careful, but you have to understand that, again, the value proposition and what are you getting for what you're paying for. All right. And there's a whole range of fees. Now, some of these managed accounts will use a lot of index funds, which are typically lower cost investments. And so if you have a plan where your target date fund, the second thing we talked about, is significantly higher than the first option, the do-it-yourself method, right? And you add on this number 3, you do this advisory services or managed account option, but they're using some of the lowest cost funds in your plan, and you do the math, it actually could be these managed accounts could be fairly comparable to what you would pay in a target date fund. Again, not always. Some plans it's not going to be. Other plans it is going to be. It just depends. You really have to dig in and see what the fees and expenses are. And we've talked a lot about fees, and one thing I don't think I mentioned yet, and one thing that you want to take note of when you're evaluating the investments in your plan, among other things, right? You want to look at the investment objectives and the performance and what your targeted allocation should be and all that sort of thing. But you want to look at what's called the expense ratio, which is a percentage. How much does it cost you to own this fund every year? And the money's automatically deducted out of your account. Again, a lot of times in the background, you're not even going to see it. You will see a separate line item typically for the advisory programs as a separate charge. But the expense ratios for the underlying investments and funds, those fees and expenses are all netted out in the background. You don't even see that money come out typically. So you want to know what that looks like. There's some plans out there where it's practically free. It could be 0.01, 0.02, 0.05. Those are bare bones, super, super low types of expenses. That's fantastic. There might be other plans out there where they are significantly higher. You could have a plan, again, depending on the size of your employer, that's charging upwards of 0.5%, 1%, even in some cases 2%, and in egregious cases over 2%, right? In terms of the different types of funds. So you want to know what that looks like, because that can have a significant impact on your overall size of your retirement portfolio over a period of decades, depending on what the fees and expenses are. I was looking even at our plan, and we had an international fund, and it was like 0.07%. We had another international fund in the same plan that was 0.7, I think it was 0.76%. So over 10 times more than the first one. Well, then you have to ask, okay, well, what's the difference? Who's managing it? What's the investment strategy? Is this one an index fund that's mostly passive, so it has a lower expense? Is this one more active, where there's a portfolio manager that's making day-to-day decisions on the portfolio? Does it matter? Is that worth it to you, right? There's the whole active-passive argument. We won't go there today. But you just need to understand what that looks like. So one layer of expenses, again, it's going to be your expense ratio. The plan sometimes will pass other costs on to the participants, which is you as an employee in the plan. You're participating in the plan at work. Sometimes it could be they will label it as some type of an administration fee or charge. That could be for the plan's consultant, if the plan has a consultant. That could be for the investment committee, which also can be done by the consultant. It could be for a company that has a force of advisors, whether it's behind a phone, behind a computer, on site, whatever it is, it's all kind of baked into that. So that's an expense that typically everybody in the plan is paying unless the employer decides to pick up the cost. Well, that's something that you probably want to know about, right? There's other administrative type of fees that will cover things like the annual mailers and disclosures that need to go out, things like that. Somebody somewhere is paying for that. So you just want to know what your all-in costs are on your plan. Larger companies typically subsidize the vast majority of these costs and these expenses. So more than likely for those bigger companies, you're probably only paying for the expense ratios for the individual funds that you hold in your portfolio. Other ones, especially smaller companies, they could pass this cost on to the employees. There could be a per participant charge. I've seen that before, where based on the number of folks in the plan, they're assessed, a certain dollar amount per year to be a participant in the plan. So that's shared equally. Other times it's done as a flat percentage. Sometimes when plans are what we call going out to bid and trying to get multiple offers or bids from different companies, and they get more and more competitive, you'll see these fees drop significantly. And most of the time, again, it's based on the size of the plan and the number of providers that the plan has. A lot of plans, there's only one retirement provider. And if it's a big company, you're probably getting a pretty good deal. Other times, you might have multiple companies that you can choose from depending on where you work. And in that case, you may not be getting as good of a deal, especially if it's a smaller employer or organization. So there's a lot of considerations here, but I guess the point of today's episode is to make everybody realize that your retirement plan is not free, especially your retirement plan at work. Someone somewhere is paying for that, whether it's the employer subsidizing the cost and looking at that as part of somebody's total compensation, or if it's the employees that are paying some of that cost on a dollar per head or percentage basis. And then, of course, you have the investment expenses for the different funds. And a lot of that has to do with the funds that they're using, the share classes that they're using. Again, the size of the plan, the more assets under management, as we like to say, typically the lower the cost is going to be for that particular fund. You're going to get a better share class. So there's a lot of different things going on. But at the bottom line, you want to know, what are you paying? But also, what are you getting, right? Do you have access to the company that's holding your plan? Can you call them? Or is it just some 1-800 unlicensed good luck customer service call center that you're never going to get any assistance from? And that does happen out there, right? There's people that will have a plan at work that's great. It's super low cost. It's super competitive. But nobody's talking to their employees about retirement income planning. Nobody's doing retirement readiness. Nobody's looking at detailed projections. Nobody's helping them with selecting their investments in their portfolio outside of the target date fund or perhaps the managed account, right? So sometimes there's a lot to be desired, and people will have an outside financial advisor that's helping them put all the pieces together. So you may have a super low cost plan, but what are you getting in return? You may not be getting any additional services. Or you can have a plan that's middle of the road in cost or potentially even higher in cost, but if you're getting value out of that, well, perhaps it's worth it, or maybe it's not, right? That's for you to decide. So first step would be to take a look at the plan that you have, see what your fees and expenses are. And then also, this show really isn't about this, but you should do a comprehensive sort of analysis of the plan. What are the restrictions in the plan, right? Something that comes up a fair amount, and I'll probably just end with this, a fair amount of time in different plans is most people think when they go to work for one employer and they go to work for employer number two, we'll call it, that they have to roll their money into the second plan. That's not necessarily the case. There's some plans, if you don't have a lot of money in them, will have what's called a force out. And a lot of times we'll do that annually. So if your balance is below a certain threshold, they're going to mail you a letter and say, fuck off, or here's what we're going to do with your money, right? And you got to make a decision. But you don't necessarily have to move it into your new retirement plan at work. And sometimes the new retirement plans or retirement plans at work may not even accept incoming transfers and rollovers. Most of them do, but sometimes they don't. But let's say you had some money in a plan and you were thinking about buying your first home. Maybe you had modest savings, you didn't have a lot put back, and you needed a little bit of extra boost to your cash pile to make the deal happen if you were going to buy some real estate, for example. Well, if you rolled that old employer plan into an IRA, an individual retirement account, you might qualify for the first-time home buyer exemption up to $10,000, and you might be able to use a portion of the money for that. If instead you rolled it into your new employer's plan, which is not an IRA, let's say you went from a 401k to another 401k, you're not going to have that same option, right, typically. So you want to know what that looks like. Some plans, when you hit a certain age, I had a client today I was talking to, and he wanted to know about taking money out of the plan. He has kind of a weird situation, but he's over age 59 and a half, so he can do that even if he's still working at that employer. Some other plans don't allow for that at all. They say, no, too bad, regardless of your age. So you want to know what the details of the plan are that you're considering. And the best way to do that is to ask for what most plans have, which is called an SPD document, which stands for Summary Plan Description, SPD. you can ask for that. And it's pretty much going to be the Cliff Notes version of the much longer document, consider the plan document, which outlines all the nitty-gritty of what you can and can't do in the plan and who's eligible for the plan and how this works and is Roth allowed, is it not allowed, or loans allowed, are they not allowed, can you do a hardship, can you do an unforeseen emergency, blah, 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 blah. All that stuff's going to be outlined in there. If you ask for the SPD, the summary plan description document, you can take a look at that. And if you have a financial advisor that's not, part of the plan at work that you're working with, they're probably, hopefully, if they're any good, going to ask you to provide that document to them, especially if you have questions about your plan at work or you're not sure about something and you want to be looking at the bigger picture. That should be part of your employee benefits overview that they hopefully are doing with you. So again, assuming you're paying them for that, there's different scopes of services and scope of work that's out there for different people, and that's beyond the scope of today's show. So is my retirement plan free? No. The real question is, how much are you paying for it? That's what you want to find out. You can check out the fees and expenses. Again, the expense ratios, any other ancillary costs on the plan. Bigger the company, typically lower the cost. Smaller the company, typically higher the cost. So just know what you're paying, know what you're getting, do the comparison, understand the value proposition, and then you can make a decision about, hey, do I just want to put in enough to get the match from my employer, assuming there is one, and get the fuck out? Some people call this matching out. So if it's a shit plan with high expenses, but they're still going to give you some free money, then put in enough to get the maximum match and then get the hell out of the plan and go invest in your IRA or your Roth IRA or your brokerage account or all of the above. Again, not advice, just information, entertainment, right? Or your plan might be super low cost. And you might say, hey, I'm going to pump this thing. I'm going to max this thing out every year. These investments are great. Perfect. Go for it, right? So you have to do that due diligence and figure out what that looks like for you. And there are some other types of accounts out there that we're not going to get into today. There's some self-directed accounts. Maybe we'll do a separate show on self-directed accounts at some point where you can do alternative types of assets and investments. But I'm typically here talking about folks that are W-2 employees that work for a company that has a retirement plan at work, more commonly, most often, a 401k plan that allows you to invest in some way, shape, or form in the stock market. That's kind of what we're covering on today's episode. So I hope you found this useful, and we will see you in the next episode.
Check the mic and make sure it sound right, boys.